Welcome back to the Daily Hunt, your morning kickstart into the market, bringing you the freshest AI-generated insights to get your day going. I'm Ethan, ready to uncover some exciting growth potential.
And I'm Brooke, here to make sure we're looking at the numbers and managing those risks. Well, Ethan, looking at the data we crawled overnight, it's quite a mix today. We've got a good number of posts covering a diverse range of stocks.
Yeah, definitely a lot to dig into. I'd say we have a couple of really hot candidates showing some incredible momentum, and, a fair share of those high-risk, high-reward plays that keep things interesting.
Interesting is one word for it. I'd lean more towards very risky for a lot of what we're seeing, especially when you start peeling back the layers on those KPIs. But let's jump right into it.
All right, let's kick things off with a true standout today, Eli Lilly, or LLY. The AI flagged this one with a strongly bullish sentiment, and for good reason. We're seeing reports of the stock just rocketing higher, contributing to a broader drug stock rally. It saw an over 8% single-day increase yesterday. With incredible revenue growth at nearly 38% and an astounding return on equity of 86%, this company is just crushing it. HSBC even upped their price target, though LLY has already blown past it. This is a buy, plain and simple.
Whoa, slow down there, Ethan. You sound like you're already sprinting to the bank. Yes, LLY's metrics like that revenue growth and ROE are absolutely stellar, no denying that. But let's remember, its price-to-earnings ratio is still quite high at around 47. You're paying a premium for that growth. And while you're focused on the positives, let's not ignore that debt-to-equity ratio of nearly 200. It's definitely generating profits, but that's a significant amount of leverage. For now, I'd say this is an investigate as buy, but it's not without its existing valuation and debt considerations.
Fair enough, Brooke, but sometimes you just gotta ride that wave when the fundamentals are this strong. Now, shifting gears a bit to United Health Group, UNH. We've got some mixed signals here, but I'm leaning towards a cautiously optimistic view. Some community members are calling it a safe value long-term play, predicting it will test $400 soon. And Leerink Partners even upped their price target to $402. Its PE is relatively low at about 14.95, and it offers a solid dividend yield of 2.56%. It's below its 52-week high, so there's potential for a nice recovery for long-term holders.
Well, Ethan, while the PE and dividend are attractive, especially for value investors, let's not overlook that UNH has seen a dramatic drop from its 52-week high of 630. That kind of decline usually points to some underlying concerns. Plus, they're strategically dropping Medicare Advantage plans in over 100 counties, which could impact future revenue. And with a debt-to-equity ratio of over 75 for a stock considered safe, that's still a sizable leverage to carry. I'd classify UNH as an investigate as cautious buy. It's got potential, but you need to understand why it took such a hit.
All right, cautious as always, Brooke. Let's talk about Applied Digital, APLD. The community sentiment here is absolutely electric. We're seeing to-the-moon comments, and Roth Capital even raised their price target to $43. This company is positioned perfectly in the AI data center boom, with rumors of a major hyperscaler deal by the end of October. People are calling for all-in plays here because of the sheer potential in this space.
Ethan, electric is one way to put it. I'd call it highly speculative. While the AI data center story for APLD is compelling, the numbers are quite frankly concerning. The company is currently unprofitable with a net profit margin of negative 1.6 and negative EPS. Its debt-to-equity ratio is an astronomical 110, and its beta is over 6, indicating extreme volatility. This stock is trading almost entirely on future promises, not current financial health. This is a clear stay away for most investors. It's a pure gamble.
Ouch, Brooke, you're really bringing the thunder today. Now, on to AMD, a name that always gets people talking. There was some buzz about Intel potentially becoming a foundry customer for AMD, which, is a massive validation of AMD's tech. They're also pushing hard into AI partnerships. That sounds like a powerful play to me.
That Intel news for AMD is interesting, but we saw conflicting sentiment data. Multiple analyses pointed to significant red flags. We're talking a negative operating margin, meaning they're losing money from core operations. And despite any future potential, a PE ratio over 95 is extremely high for a company that isn't profitable at its operational core. Plus, its debt-to-equity ratio is also quite elevated at over 6. While the Intel story is intriguing, the current financials suggest a stay away. It's just too much risk for the current valuation.
All right. I hear you. The numbers don't lie. And speaking of staying away, we also looked at Gap. Now, some folks were really bullish on a new viral ad campaign and strong new management, seeing it as undervalued with a low PE.
Yes, but Gap also shows an alarmingly high debt-to-equity of over 100 and near zero revenue growth. That low PE might be a warning sign, not an undervaluation, so stay away there.
We also had Novo Nordisk, NVO, which some users were super bullish on due to its obesity solutions, but it's actually dropped over 50% from its 52-week high.
And Morgan Stanley downgraded NVO to underweight. That massive price drop and institutional concern mean it's a stay away for now.
We saw Reddit, RDDT, with some optimism about AI data monetization, but also huge valuation concerns.
Extremely high PE of over 100, declining user engagement, and a sharp stock slide, definitely a stay away for RDDT.
And DraftKings, DKNG, which was also showing some big losses for investors.
Unprofitable, sky-high debt at 189, and overvalued. DKNG is another clear stay away.
We also had Automatic Data Processing, ADP, mainly discussed for its jobs report, but not really as a stock.
High valuation and potential headwinds from a weakening job market that ADP itself is reporting. A cautious stay away.
And the truly wild one, PACS Group, PACS.
Unreliable financial statements, Ethan. The company admitted to overstating revenue. And a debt-to-equity pushing 470. That's a definite stay away.
We also had a mention of Antero Resources, AR.
Extremely high debt again at over 46, despite some analyst upgrades. High risk, so stay away.
And finally, American Eagle Outfitters, AEO, which some saw as a positive benchmark for its ad campaigns.
But with negative revenue growth and high debt, AEO is also a stay away from a risk management perspective.
All right, today's candidates for deeper analysis. All right, so after all that back and forth, here are today's candidates for you to take a deeper look at. Investigate as buy, Eli Lilly and Company, LLY. Investigate as cautious buy, United Health Group Incorporated, UNH.
And for those of you with an appetite for serious risk and a highly speculative play, based on the community's extreme optimism despite the red flags, our speculative gamble of the day is...
Investigate as speculative gamble, Applied Digital Corporation, APLD. That's all for today's Daily Hunt. Remember, the information we've shared is compiled from publicly available sources, and our AI-generated insights are market commentary, not financial advice. It's designed to give you a starting point for your own research.
Absolutely. This data could be outdated, so you must do your own due diligence before making any decisions. We are not making any guarantees or promises. The market is a wild place, and knowledge is truly your best asset.
Thanks for tuning in, and we'll catch you next time on The Daily Hunt.